Anthony, most traded ETF on your platform, I have been noting this for weeks now, not on your platform, but everywhere. Ultra short QQQ, symbol SQQQ. This is 3 times the inverse of the S&P 500 on a daily basis. And normally you see the S&P 500 funds most actively traded. Why have retail investors suddenly embraced leverage in inverse ETFs, particularly the NASDAQ 100 ones?
Right. Well, NASDAQ 100, as you know, is very tech heavy. Tech heavy seems to be what our customers are into trading, right? It's the ones that move intraday, right? It's less boring, to put it that way. And I think there's a couple different reasons. One, I don't think is talked about enough, is the retail investor, the average account went from 5,000 to now averaging about 3,000 on a platform like Webull. That would also apply to a Robinhood type investor. They sometimes won't even qualify for leverage in terms of utilizing margin because of their account balance. So they're utilizing these leverage ETFs to make up for their account being downgraded maybe from a margin or to a non-leverage margin account or possibly even only a cash account to trade their stocks.
Yeah. So, Nick, every day, the most actively traded ETFs in terms of shares traded are what we talked about, that SQQ and the TQQ, which is the other side of the whole thing, 3 times leverage on the triple Q. SPY is still the largest in terms of dollar value, but I see $5 billion in notional trading of SQQQ every day. I would have thought professional traders would be using these, but Anthony says retail traders are starting to use them now. Is this a sign that retail is pessimistic? What do we take away? Is there a risk about all of this use of leverage and inverse ETFs around triple Qs?
No, I think from a market standpoint, it tells us that a lot of retail traders are trying to claw back maybe some losses from earlier in the year. They're down, they want to get back up, and so they view the riskier bets as the most efficient way to try to claw back some of those losses and get back flat on the year, even make some money. So I think what we're seeing is a really interesting adjustment in risk tolerance. You'd think that when markets go down, risk tolerance goes down. For a lot of accounts, for a lot of clients, it goes up, and that's what we're seeing here.
So the risk tolerance is going down, you think?
Risk tolerance, as far as how a long-only investor would think, maybe is going down. Hey, I want to be out. That's what we see in the fund flows. But for a trader, somebody who wants to make money in the market, you got to take your risk tolerance up in order to make that money back.
Yeah. You know, the fund flows have really been confusing me recently. I follow them, and I think they tend to mean something at extremes. The problem I have here is, let's look at the flows here. April, we saw peak outflows. It changed in May, but it's still not consistent. So I see inflows into the S&P 500 and outflows in energy here. That's kind of interesting because energy was the big outperformer in May. I'm not sure what to make of this. And then on bonds, I want you to comment on this separately. We see modest inflows after huge outflows early in the year. So tell me what you're expert at making sense of fund flows here. I want to just address equities first.
Sure.
What is this trying to tell us?
It tells us primarily that investors are pulling back. And the energy point you made is really critical. Energy, XLE was up 17% last month. Made a lot of money in that name. People were pulling back because they're pulling back on risk exposure generally. On our tracking of these fund flows, the money seems to be going directly into consumption. It's not going to bank accounts, it's not going to money market funds. It's being used primarily for consumption in an inflationary economy. So that's where the money is going. And as long as inflation is high, that's going to be, I think, the trend that we see.
But the trend follower in me says, gee, energy is the biggest performer of the year, and yet we saw some modest outflows. You'd think there'd still be money going into it. I'm trying to sort of make sense about it in the traditional way I understand trend following, for crying out loud.
You coined a marvelous phrase in the last decade, the most hated bull market in history, right? Why was it? Because flows were negative and stock prices kept going up. This energy rally is turning into the most hated sector rally of this year.
Yeah. Anthony, it looks like the active trader is still pretty active. I see that in your numbers, but you've told me separately that the fair weather trader is gone. I love that phrase, the fair weather trader is gone. Explain to us what that means when you say the fair weather trader is gone, the active trader is still there.
I mean, the equity markets for the past 10 years has been operating with a lot of tailwinds helping it along, especially for newer and less experienced traders, right? It was basically buy, stock goes up, buy more. Obviously that has changed over the last several months. We're entering bear market territory, and there's a lot of traders that have never seen a down market, and they've been burned, and they just walk away. And these are, not necessarily traders that aren't long-term investors, but these are traders that thought they could make money actively trading.
Yeah.
Right. So those are the fair weather traders I talk about. I don't want to differentiate, right? They're still investors,
yeah,
but not the traders. Active traders are still remain very, very active. I mean, short sales alone, we're seeing up 400% this quarter on our platform, right? Which, compared to last year, that's an active trader utilizing this volatility.
But I'm looking at the numbers here. Average assets under management, $5,000 a few months ago, and now $3,000. Mm-hmm. So it looks like, what do you call them? The self-directed trader, whatever you want to call them. It seems like they're having a rough time of it right now.
Yeah.
So you run a business. You run a trading platform. What are you and other trading platforms, what are your competitors doing to keep people on the platform? If not actively trading, what do they do? What are you doing to keep them there?
Well, like our customers, we're new, right? So Webull's been around for 4 years. We're evolving and maturing just with our users. So we started off self-directing. We're now offering products of recurring deposits, recurring investments, and we're soon going to be rolling out more passive investment options, right? Not everyone is happy looking at their phone 12 hours a day nonstop trying to chart or time a market. A lot of people, especially with these volatiles, would rather kind of set it and forget it.
When you say passive, my heart leaps when I say passive, because I'm a Jack Bogle guy, as you all know. But what does that mean to you? How do you encourage people to do passive investing from the active retail environment we've been seeing for several years?
Offer easy to navigate portfolio building indexing tools that customers can then create to their own risk assessment profile and then actively invest in that on any given period of time that is sufficient for their own budget.
Portfolio building index tools. Mm-hmm. I mean, this is an amazing thing to hear from, retail trading platform, Nick. Mm-hmm. Is this signs that the retail traders are evolving in the way they look? I'm hearing talking about passive investing here from an active retail trading platform.
Hey, look at our generation. We grew up in the 1990s trading tech stocks. Then they blew up. Then we realized we got to get serious. Start putting more into the 401k. Start putting more into personal investments. Understand indexing and passive investing. Every generation goes through the same evolution, I think, starting with an exciting bull market, but then realizing this is a very long game and you got to play it as a long game.
So it sounds like it's time for a lot of younger traders to grow up and think a little bit longer term.
Just like we did.
Yeah. Yeah.
Right.
Well, it happened in '99 and 2000.
People grew up fast.